Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about cash flows. We started out talking about why it's important and the conceptual background behind FASB's decisions and the information that we can extract from cash flows. And then we started our example, Avery Arrowheads, walking through how we actually create a statement of cash flows. Not the simplified version we've done in the past, but a real statement of cash flows. And so far, we've gotten through only the first two steps completely and started on the third step. So the first step was to get a total change in cash as a check figure. The second step was to set up our worksheets. The third step is to go through specialized transactions and make the necessary adjustments to account for cash flows and the balance sheet effects of those cash flows. And as we've done that, we've been filling out our worksheets so that we've got those numbers to build our statement of cash flows later on. So we're now on our 8th transaction of these special transactions. Last time we did a non-cash transaction, and then we did an operating section adjustment where we had to do the switch from accrual accounting and the number in net income to the actual cash effect. And now it's time to go on with some other transactions. And we're going to start with this one. During year 6, AAI sold marketable securities, which it had acquired for $222,000 for $275,000. So first off, operating, investing, or financing. Well, the sale of securities can be either operating or investing. If they're trading securities, it's operating. If they're available for sale or equity securities, then they go in investing. And we've already looked back at our balance sheet. This company has no trading portfolio and no cash equivalents account. Either of those would signal trading securities. What they have are the equity securities that we just accounted for at the end of the last segment and the available for sale securities. So this is an available for sale security, but goes in investing. We buy or sell it. So let's start with the cash effect. And we got $275,000 from selling these items. And our balance sheet effect would be a decrease in securities available for sale, is what this company calls them. $222,000. And now I know the cash effect, I know the balance sheet effect, I know there's a gain in there as well, but we'll deal with that in a future step. That's step 4. So for now, I've got everything done that I need to, so I can put that cash effect into my worksheet. So cash received from sale of securities. And it'll be a positive $275,000. That takes care of that transaction. Let's move on to our next transaction. In this case, we issued 150,000 shares of stock as part of a 50% stock dividend. So as always, the first question, operating, investing, financing. And the answer to this one is none. This is a stock dividend, which means there's no cash effect. So we don't have to account for it, adjust for it, right? Wrong. Once again, we're still going to make some notes because I need to know the total effect as a non-cash disclosure, number 1. And number 2, when I get to step 5, I'm going to go back through the balance sheet to see if there's anything I haven't accounted for. And anything I haven't accounted for, I'm going to assume was caused by a cash effect. Well, I know that there's some balance sheet changes because of this stock dividend that aren't because of cash. They're because of this non-cash transaction. So I want to make a note here in step 3 so that when I get to step 5 and I start looking at balance sheet accounts, I'll look at these accounts and say, oh, yes, they've changed, but no, it's not from cash. So that's what I'm doing at this point. And the best way to figure out what happens to our balance sheet effect is to do the journal entry for this stock dividend. We debit retained earnings, credit common stock. We might also credit additional paid in capital common stock, but only if it's a small stock dividend. If it's a large stock dividend, we just record par value, and that's it. So I don't have any additional paid in capital. If it's a small stock dividend, then I record the market value of the shares, and I have to put the par value into common stock and the rest of the market value into additional paid in capital. The threshold for the small, large stock dividend is 20% and less is small, 25% and more is a large stock dividend. And then we have a 5% no man's land, which I have no idea why. I've tried to figure out FASB's logic on that one, and I haven't figured it out. So most companies just are very careful because there is this no man's land, and we don't know what a 21 or 23% stock dividend would be, large or small. They're very careful to either do 20% or less or 25% and higher, so that we don't have to figure out what to do in this area FASB hasn't defined. So in this case, we're well above the 25% threshold. It's a 50% stock dividend. So I'm just going to record par value. And from earlier transactions or by looking back at the balance sheet, I know that there's a $10 par. So I'm going to credit common stock, 150,000 shares times $10 per share. And that's going to be my debit to retained earnings as well. So this is going to be an increase to common stock, 1.5 billion, and a decrease to retained earnings. Those are my two balance sheet accounts, and I got to do a journal entry. So life is good. That's all that really matters. Because there's no cash effect here, I don't have to worry about putting anything into my worksheets, so I can just move right on to transaction 10. This next transaction is to issue $3 million worth of bonds at face value on August 1st, year 6. Face value makes it a little easier for us right now, but if it was not at face value, then we could do the journal entry and find the balance sheet accounts. That would be fun too, but for sake of time, I made it simple and we would just have a face value issue. So first question, is it operating, investing, or financing? The issuance of a bond is financing. The cash effect then, if I issued it at face value, then 3 million of cash came in, and that's also my balance sheet effect. I had an increase bonds payable of 3 million. Now, we might stop here and say, wait a minute, is this a convertible bond or a regular bond? This company has both kinds. Which kind is this? Well, we would have to go back and look at the contract of these bonds, but basic accounting assumptions here, a convertible bond is something special. We would have had a note that it was a convertible bond if it was. So the lack of a note suggests that it's a traditional bond payable. Doesn't guarantee it. If this was a real company, I'd go back and check. But the assumption would be there's no note that it is a convertible bond, so it must be a normal bond. And now that I know the cash effect and the balance sheet effect, I can put this into my worksheet. Cash received from issuance of bond. That was a positive $3 million because cash came in. And that takes care of that transaction. The next special transaction is the sale of some treasury stock. We purchased this stock for $20 per share, and then we sold it for $46 per share on January 18th of year 6. First question, operating, investing, or financing. And because it's the sale of treasury stock, that means we are giving shares to owners and they're giving us money. It's a transaction with investors, so it's financing. And the cash effect is going to be the 500 shares times the $46 per share, $23,000 coming in. For the balance sheet effect, there's going to be a couple of accounts affected. And again, the best way to understand what we're doing with this is to do the journal entry. So cash comes in, 23,000. We would credit our treasury stock account, and we would credit treasury stock for what we paid for it. We take those 500 shares at the $20 a share, and the difference would go to additional paid-in capital. Now, normally we'd use additional paid-in capital treasury stock, but I need to check and see for sure what this company calls it so that I can match it up with its balance sheet. So let's switch to the balance sheet, and it looks like they've got additional paid-in capital common stock, then they've got an other paid-in capital. And since I don't have a specific paid-in capital for treasury stock, it must be included in that other paid-in capital account. So other paid-in capital, and that would be for the difference between the two. My balance sheet effect would be a decrease to treasury stock and an increase to other paid-in capital, 13,000, because paid-in capital is an equity account, so credit increases the account. Well, now I know my cash effect and my balance sheet effects, so again, I can put it into my worksheet. This is cash received, sale of treasury stock, $23,000. Now, We've done a couple of journal entries to help us understand the balance sheet effects of these transactions, but I haven't put any descriptions in. Again, I only put descriptions in when they're real entries. When it's just me making notes and trying to calculate some numbers, I leave out the descriptions to signal that this is not a real formal entry that's in my books. It's just you making notes. So don't hang me here for not including descriptions. It's just because they're calculations, not real formal entries that are doing the accounting. The real entry was made way back when we actually sold the stock back on January 18th. Our next special transaction is the purchase of some treasury stock. So we sold a bunch off in January. In October, we bought some back. If we bought them back, there's definitely cash flow involved because I purchased them. Is it operating, investing, or financing? If it's a transaction with an owner, then it's financing. My cash effect, let's see, I purchased 1,000 shares at $38 a share. I'm going to make that a negative because cash goes out. My balance sheet effect, I would credit cash and debit treasury stock. So I have an increase to treasury stock of 38,000. Now that I know the balance sheet effect and the cash effect, I can put it into my worksheet. Cash paid to purchase treasury stock. And one important thing that I want to make mention of right here, you'll notice I don't net these out. I also don't spell cash right. Let me fix that. There we go. I don't net these out. I don't put, well, the net effect was to purchase treasury stock, so I'll just put in a negative 15,000. No, you can't do it that way. You have to show what's really going on. So I keep two separate line items for all of these kinds of transactions. So I have two separate line items for the purchase and sale of treasury stock. If I purchase bonds and repaid bonds, two separate line items, etc. So we don't lump them together. We keep them separate because we want to show our investors what's really going on. We're going to take a break right here. We've reviewed some cool transactions. We've done some journal entries, so life is good. We've got our worksheet much farther along than it was before. When we come back, we've got a couple of last special transactions to look at, and then we need to look at step 4 and see what we do as we continue on with this process. We'll see you then. Thanks.